Welcome to Technical Analysis Essentials. In this session, we'll explore the basics of technical analysis, focusing on three key tools: moving averages, relative strength index, and MACD. Technical analysis helps traders understand market trends and make informed decisions based on historical price data. By the end of this session, you'll have a solid understanding of these tools and how to use them effectively in your trading strategy. What is a moving average? A moving average smooths out price data to highlight trends over time. Two types commonly used: simple moving average, the average closing price over a specific period; exponential moving average, similar to a simple moving average but gives more weight to recent prices. How to use moving averages. Trend identification. If the price is above the moving average, the market is in an uptrend; below it, a downtrend. Crossovers. When a short-term moving average crosses above a long-term moving average, it signals a potential buy. When it crosses below, it signals a potential sell. Practical example. Imagine a stock price consistently trading above its 50-day exponential moving average. This indicates a strong uptrend, suggesting potential buying opportunities on pullbacks. What is RSI? RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is used to identify overbought or oversold conditions. How to use RSI. Overbought. RSI above 70 indicates that the asset may be overbought, suggesting a potential reversal or pullback. Oversold. RSI below 30 indicates that the asset may be oversold, suggesting a potential bounce or upward reversal. Divergences. If the price makes a higher high, but RSI makes a lower high, it signals a bearish divergence, indicating a potential price drop. If the price makes a lower low, but RSI makes a higher low, it signals a bullish divergence, indicating a potential price rise. Practical example. A stock with an RSI of 80 may be due for a pullback. Combine this insight with other tools, such as moving averages, to confirm your trade decision. What is a MACD? MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. Components. A MACD line, the difference between the 12-day and 26-day exponential moving averages. Signal line, a 9-day exponential moving average of the MACD line. Histogram, the difference between the MACD line and the signal line. How to use MACD. Crossover signals. When the MACD line crosses above the signal line, it indicates a potential buy signal. When it crosses below, it indicates a potential sell signal. Divergences. Similar to RSI, divergences between the MACD and price movement can signal trend reversals. Practical example. If the MACD line crosses above the signal line while the histogram turns positive, it may confirm the start of an uptrend. To summarize, moving averages help identify trends and crossovers. RSI indicates overbought or oversold conditions and identifies divergences. MACD combines trend following and momentum to provide buy and sell signals. While each tool is powerful on its own, combining them improves accuracy. Remember, no single tool guarantees success. Always use these indicators alongside other analysis methods and risk management strategies. Practice exercise. Open a demo trading platform and add moving averages, RSI, and MACD to your charts. Identify trends, overbought, oversold conditions, and crossover signals on historical price data. This hands-on practice will solidify your understanding and prepare you for live markets. Let me know if you have questions or need more examples.